Hello and welcome to another episode of Creative Real Estate. Today, I am extremely excited to have Shane Connor on the line with us. Shane, welcome to the podcast.
Rikki, it's a pleasure to be here. Thank you for having me.
Yeah, it's awesome to have you. So you're currently working with Bull Realty and you're playing in the senior living space. Before we get into all of that, I want to hear your story and how exactly you got into the real estate environment.
Absolutely. Let's dive in.
Perfect. Take it away.
My real estate journey is, I guess, an interesting one. You know, kind of fell into it, I guess, as a lot of people do. But I'm originally from Philadelphia. I came down to Atlanta in 2012, Atlanta, Georgia. I was in a healthcare recruiting and staffing business. So that's where I started to really fall in love with the healthcare aspect of things. But I was a commissioned producer. So we were selling recruiting and staffing services throughout the healthcare industry, coast to coast. And have been fortunate enough to develop some relationships and clients with some large Fortune 500, actually Fortune 50 companies. And so as a commissioned salesperson, I was having a couple good years of income, and I was looking for some diversification outside of my, stocks and bonds, my 401k at the time. And through some research and some connections, I landed in the multifamily syndication business. I was an LP in a deal in Texas and then in another private fund. And that kind of opened my whole world, opened my eyes to that whole world of kind of private real estate and commercial real estate as a whole, which, although I was a finance guy by trade in college and in the industry, I didn't really know a ton about it and kind of just fell in love with it.
That's amazing. And how did you hear about the multifamily side of the business and getting involved in those investments?
Yeah, so it's hard for me to actually pinpoint exactly what it was, but I know I was on a couple of the large forums online. I think Bigger Pockets might have been one of them. But just being a salesperson and a relationship guy, I had been outreaching to some people who I noticed were big operators and sponsors in the space. And then it ended up pulling the trigger on a small LP investment. And then I got a little bit bigger on my next one. And then ultimately what I was able to do with some of my relationship building was start to co-GP with some of the groups that operated deals in the markets that I was interested in. And I was helping to bring others from my sales network and some of the medical network, the doctors that I had been working with as clients, helping to bring these opportunities to other people. So that's where I really sunk my teeth into the acquisition side of things, the asset management, underwriting, all that kind of stuff over 2016, 17, and into 2019.
Yeah, I think it's amazing. So now you're in the senior housing market. You come from this background where you were doing recruitment sort of for staffing in that space. Then you got dragged into, or not dragged into, but you fell into the multifamily syndication side of things and you started looking at apartments. And today you're tapping more back into the senior housing, acting as a broker and building out that network. I'm sure you'll be co-investing in some of your own senior housing deals at some point in time too. What draws you back into the senior housing space? What do you love about it?
So that's a great question. There's probably a few things. So obviously, once I had fallen into the healthcare industry, I was working with a lot of senior housing operators, providing staff and recruitment on their operations side. I actually went back, got my master's in healthcare administration because I had just really taken a keen interest to all the different pieces of the industry. Then I had a personal experience in 2018. I had lost my father at the age of 62, and he had suffered a 3-year battle of heart failure. And I kind of watched, in senior housing, we talk about the spectrum, which I think we'll dive into a little bit later in the conversation. But it's essentially as somebody gets older and ages and their body changes, there's different types of environments that they might live in. Kind of watched my dad go through that process in all but 3 years until he ultimately passed away. But I kind of saw how impactful just the environment that he was in little things, whether it would be the quality of the food or the quality of the experience, whether clinical or non-clinical staff members were treating him and also the experience from the family side. And then once I was kind of in the investing business, I was dealing with a lot of brokers. People knew that I had a healthcare background. I had actually done a little startup investment in a senior living operations company. So I was getting people calling me all the time saying, hey, can you help me look at this skilled nursing deal? Or can you help me look at this assisted living deal? These were people that came from typically straight multifamily or other asset classes. And I was just noticing that there was what I perceived to be a large void of good, knowledgeable advisory brokers in that sector of the business, senior housing. And obviously the demographics, everybody likes to talk about them, but they are quite large. 10,000 people turn 65 every day, and they'll do that until 2030.
Wow.
So when I kind of sat back and looked at everything, I really felt like bringing my skill set and my background of real estate, finance, and healthcare was a good opportunity to bring all of that to the brokerage and advisory side, and really helping mainly institutional quality investors and owners, with dispositions and acquisitions.
So that's quite a story.
A little windy.
It's very unique, I think it's very purpose driven as to where you come today. I think your story is unique and should give you a really competitive edge in the market. It's obviously, I can't even begin to imagine what it was like dealing with your dad's quick escalation of health issues and then passing. Yeah, I think, everything happens for a reason. It's not the purpose of this call at all, but I think you're uniquely geared to be able to empower people to understand exactly what to look for in the senior housing markets. And sorry, go ahead.
And in this space, it's a little different than some other asset classes where, especially as you get a little closer towards assisted living, obviously skilled nursing, anything in that realm, the people that are in the business, whether it be from an investment standpoint or the operators who are typically managing the properties on behalf of owners, a lot of times they're vertically integrated. But the point is, the people that are in this space, there's usually an element of care driving. It's not just about how much NOI can we get out of this building. All that metrics is important. We still need to run a good investment, but the actual what they're doing within the facility, taking care of seniors, providing a great space for mom or dad, for the adult children. So there's usually a bigger why behind most of the players in the space. And so that's where I feel like I've been able to have good connections with some of the executives and principals, because I kind of also come from that place as well. And the finance and investment side of it kind of comes secondary to the actual why and the purpose behind what everybody's trying to do.
Yeah, that's amazing. I think it's unique that you have an opportunity to work on something that carries such a large purpose and has like a personal connection for you day in, day out. So I'm glad that you've been able to find that through this bit of a rickety period for yourself there. So you mentioned the spectrum of senior housing. So what exactly is that? Take me through that.
Yeah, so sometimes it's called spectrum, sometimes it's called curve. There's a couple different things, but the easiest way to look at it is kind of like a left to right line. And essentially it's the aging process, if you will, and the types of environments that somebody might find themselves living in as they go along. And so the beginning of it, far left, which doesn't even get qualified as senior housing sometimes, it's more of the 55 and older community. Sometimes it's called retirement community. Sometimes it's called active adult. This is probably the closest sister to true multifamily. A lot of times it will look and feel just like a large Class A resort style multifamily product, but it's just age targeted and restricted for 55 residents. And the people that live in this building might be empty nesters. The kids are off to college. They want some economic mobility, so they sell their house because they want to rent, but they really like to be around peers and others in their age group. There's usually some level of activity, a salon or a spa, those types of things on site. Okay. Then you move a little closer to the right, and that's where you get into true kind of senior housing. So that starts with independent living, kind of just as it sounds. These are communities where typically people don't need any type of care, any type of assistance, but there may be like a communal kitchen involved. There may be some planned activities by the owner or the operator. And typically you're going to have just a little more planning and involvement for your monthly fee in terms of things that you're going to get. But by and large, these people come and go as they want. They're totally free. They don't really need any assistance. After that, you're going to move to assisted living, which basically, again, as it sounds, there's some level of assistance that these people need, whether it's bathing or dressing, moving around. The meal component is going to be even more important here, with the communal kitchen serving resident meals. Not as much true nursing care involved here. You will have some families that they pay for their own nurse, go in to help with mom or dad when they're in the facility. But assisted living is when I would say the operational component starts to really make a jump from the true retirement community, and independent licensures get involved. The states are going to be regulating these facilities. So it does become a little bit more sophisticated of an operation once you're getting into assisted living. Memory care would be a bolt on to assisted living. Usually you'll see could be a 90-unit assisted living building with 10 memory care units. Sometimes You'll find those as standalone memory care units. And so these are, again, really where your Alzheimer's, dementia type patients are going to be housed. There's just some increased security measures, special locks on the doors, specialized programs that a lot of the operators are bringing in to kind of help the resident and also the family members. And then a little further to the right, that's when you get into your skilled nursing facilities. Oftentimes these are called nursing homes. These are much shorter stays, higher acuity. So really you've got registered nurses, you've got licensed practical nurses, you've got dietitian therapy. These are really more of your hardcore healthcare aspect of the facility. And these are going to be much more complex, much more sophisticated operation. So you don't see as many newer investors getting into that sector. They're going to be going more towards your independent and your assisted livings.
Okay, got it. So let me just sum that up. What did you say the very first category was?
So that would be active adult communities, or you're just age restricted. So these are just typically, they might look and feel like any other apartment community, but they're just targeted for a 55 and older community.
Got it. Okay. So we've got active living or age restricted. Then we've got independent living, then assisted living, then skilled nursing. And as you move along that curve, in theory, the clients or the tenants requiring more and more care.
Correct. And you're getting older now. The curve, because people are living longer, they're entering these spaces at different times, some maybe farther down the line now. With active adult, some of the operators are seeing that, lease ups are a little longer. It's a little longer decision process if they're selling their personal residence.
Okay.
But oftentimes these people could come in at 60 years old and they might stay for a decade in the active adult community before now they're ready for a true independent living or assisted living. And so essentially, yes, it is, as you age, you kind of go along the curve. And at the very end of it, now you've got these master plan communities called continuing care retirement communities, CCRCs. They've been around, but they're gaining in popularity. And this is typically, if you think about everything we just talked about, put it on one large plot of land.
Yeah.
And you typically pay an entrance fee when you get in. But the goal is for you to age all the way in place on the same basically location or property, instead of chopping it up where you might move across town and move to this facility and change to this facility. These are large master planned and operated communities where they'll have all the way from independent and then assisted. They'll have a skilled nursing compound as the higher acuity comes in. And these are typically meant for you to age over a long period of time across the same, piece of property. And so those are continuing to be built, large scale development projects there. But that in a sense, that entire kind of curve is what people call the senior housing spectrum, the senior living spectrum. And so as you tie that back into the demographics that everybody likes to highlight, 10,000 people a day, turning 65, you can obviously see the large amount of numbers that are going to be hitting all the different points of the spectrum over the next 10 years. And there's a really vast undersupply in certain markets of certain subtypes. Probably the most notable would be just kind of good, affordable, quality product in that independent living and even assisted living space. A lot of developers are really trying to crack the code on, getting the best blend of a high quality, so maybe just under your luxury type product, but still has a really appealing eye appeal and also functionality appeal, but still is affordable because people are living longer. Stock market's getting beat up. We can go into all those things. People are having less dollars as they go into this age of their life, and they may live into their 90s. You need to come up with a product that's going to allow people to live a long time and not deplete all of their funds.
Yeah, I remember when we were looking at assisted living or memory care facilities, just going through some of the numbers in terms of what it costs to actually stay there each month. It was expensive, and it was a nice facility, don't get me wrong, but you've got to have a lot of extra expendable income among the siblings, or very good planning ahead of as the adult, I suppose, or as the elderly taking the next step.
And memory care can become even more expensive. I mean, some of the memory care facilities can get into the $8,000, $9,000, $10,000 a month.
Yeah,
so
exactly that.
It can become quite costly.
So it's definitely something to think about. What I'm interested in understanding also is when you see this playing field across the spectrum, do you find that there are different management groups that are specialists within each of those, or do you find that there are management groups that are able to deal with active living, independent living, assisted living, and skilled nursing?
You're typically going to have it a little more segmented out. So
Okay.
you'll have groups that are skilled nursing operators, and that's typically their bread and butter. That's what they want to focus on. That's what they're good at. Because again, I mentioned that's more of the highly sophisticated, highly nursing component. So those types of people are typically not going to also be looking to operate, an active adult, or vice versa, right? If
Yes.
you've got multifamily groups that are now starting to pivot and try to get into this sector with just the age restricted communities. Well,
Yes.
they're used to more dealing with a couple leasing agents, a good property manager, kind of a smaller team to operate a community. They're not just going to try to jump in and get a license to operate a skilled nursing facility. They'll have no idea what they're doing. So
Yeah.
you do find mostly the groups like to specialize. It's becoming more popular to be vertically integrated. So as I talk to large buyers every day, most of
Yes.
them have their own operations, and they'll be looking to swap out the operator when they buy. If they're good and they're quality and it makes sense, they may look to leave that operator. But most of the time, you're going to have third-party management companies that just try to own whatever kind of subtype that they really focus on, and that's what makes the most sense because it is so specialized. It's not like just hiring a few leasing agents and a property manager and away you go.
So I'd like to dive into that a little bit. Obviously, coming more from the multifamily space, as an investor, one of the things that I love about it, and I'm going to oversimplify it, but if you're using third-party management, if they're not performing, you're generally able to get rid of them and hire a new third-party manager and put them in place. And it's not that difficult to find a replacement. This is obviously, I suppose it's probably the same with the age-restricted and active living side of things. But as you move up the spectrum or curve, it definitely gets more complex. What do you find most of the owners in this space are doing? Are they third-party managers or are they self-managing?
So there are some let's say private equity. A lot of the private equity firms will hold just good regional relationships. So if they're going to buy in the Southeast, they've kind of got a preferred operator that they know has enough reach. They've also got what you really want to try to do is cluster your properties. And that's why I think in the next decade, you're going to see a shift away from, some of these large national operators got spread too thin.
Yeah.
And you start to see buildings suffer as a result. So I think in the conversations I'm having, everybody's moving towards more of a cluster region. So a PE firm or an institutional investor that does not manage, they're just the capital side of the business, they'll hold regional relationships. And so if they're going to underwrite and look at a potential acquisition opportunity, they've got relationships, and the operators will also help them to evaluate that opportunity.
Yes.
They'll help them to understand if that's a good, yes, we can go into that market. If we don't already have a presence there, we can support, putting a regional office or regional people. They can help them look at pitfalls about the building that they might want to pass on. But typically that's what you're going to have is third-party managers that groups are holding relationships with wherever they look to buy around the country. They've got regional players. There's a real shift back to the regional players they like to have. Now, there are some groups that are self-managed, but typically they're going to also cluster. So like a conversation I had yesterday, all this group does is nursing homes, and they only do them in Florida and New York. They manage them themselves. Those are the only two territories that they want to look at. Also, there's that clustering model.
That makes a lot of sense. In terms of cap rates between these different asset types along the spectrum, what do you see over there? And I want to touch on cap rates, but also as important to go with cap rates is obviously financing. So maybe you could just elaborate on what that looks like in senior housing.
There's definitely been cap rate compression over the years. And again, I hadn't been in this space for 5 or 10 years. But if you look at the trends, they've definitely been falling as the popularity has increased. The silver tsunami, everybody likes to talk about that. So more and more dollars have poured into the product. And obviously, that's going to cause some compression.
Let me interrupt you there. Sorry. What's the silver tsunami for anyone listening that doesn't know?
So that's kind of the name that gets thrown around for that demographic that I've talked about a couple of times, the 10,000 people a day turning 65. Some of the investment funds that are targeting senior housing like to call it the silver tsunami in their offerings. It's just kind of a playful name. The people with the gray hair are coming in a big wave.
I like it. Okay.
So,
okay.
In the last year, I think 2019 and coming into 20, stabilized products trading between 6 and 7%. It's really location and actual property specific a little bit in senior housing where it's not as macro as maybe multifamily. Because even within a market, you have different pockets of affluence, within a particular submarket. And so we do see a little bit of change. But on a general range, we're seeing about 6 to 7 on stabilized. Distressed opportunities are probably going to be emerging. A lot of groups are looking for those right now.
Yes.
Expect to see cap rates a little higher on the turnarounds that we're going to expect to see Q3, Q4.
Are you seeing any of that playing out already or not yet?
We're not seeing it yet. And there's a few reasons why I think, the government acted pretty quickly. So PPP loans were pretty much widely taken out across operators in the space. What we're expecting and what the conversations that I'm having is as PPP starts to run out and now you have kind of a two-headed monster of increased expenses, PPE equipment is not going out anywhere anytime soon. So these are large increases on the operating costs. And then occupancy has been, steady at best, if not declining. And so you kind of, how long can groups hold on? And I think over the next 3 or 4 months, the game is going to really emerge to see who's out over their skis, who's not well capitalized, who's not maybe owned by large PE firms that can continue to kind of float. Yeah. That's where we're expecting the distress scenarios. I think it's too early. But then on the flip side of that, when there's all this capital being raised, I'm talking to people that are raising large distressed funds. If not as many distress scenarios emerge and there's a lot of buy side activity, that may prop up the price and continue to keep prices a little higher than the true distressed. We're not expecting to see things like 08 and 09 in the space. Okay. But also time will tell, right? I think a lot of the funds that were injected are still being used. And so I'm not expecting until later this year when we're really going to see a lot of those opportunities, but they are starting to slowly emerge.
And when you say occupancy has been coming down, I'm curious because we've got the silver tsunami taking place and that's obviously like prompting demand, but right now occupancy levels are coming down. Is that that's
as a result of COVID. I mean, you can't really lease up when the buildings are on lockdown. And a lot of these facilities starting mid-March have been in a full lockdown mode. I mean, we're just starting to see some very loosened restrictions. So for the last 2 or 3 months, most of these facilities, including independent living. So again, the independent, these people are not used to being told, that they can't go outside or they can't have people come inside.
It's difficult.
But those were included, and that's really the occupancy is just really a reflection of not being able to have lease ups and tours happening. Now those are starting. Yes. A lot of virtual tours have been being used, but a lot of the groups we're talking to, they're feeling a pent up demand. They're getting calls from families that are ready to move mom or dad into the facility, where some said that COVID's going to cause a mass pullback. Yeah. People are going to retreat from facilities. We're actually finding quite the opposite, that many are finding that these are still the best and safest environments if they're well run. I think this is actually a marketing ploy that some groups are going to use to show that they haven't had any COVID issues, that they had good infection control procedures. And if you're looking at what is the safest environment for a resident to be in, it's probably these places that have entire teams focused 24 hours a day on keeping COVID and other
things at bay.
Control. Yeah. Right. Yeah. So those are why we are starting to see occupancy rebound. We're starting to see lease ups happen as the restrictions open. But of course, there's still some environments that as they open, they may shut down again. That's what the whole country is kind of doing. So it is going to be a little bit of a wait and see in some areas. But when you're talking about the needs-based products, so needs-based being, your SNFs, your ALs, your memory cares, there's not really you can't really stop some of the people that need to live in these buildings. And that's why, you still see investors are bullish. We're still seeing deals transact. Things are still happening because you can't just wipe away the senior housing industry. It's not going to happen.
No. Yeah. And I think it's at some point, especially as you move up the curve, like there's nothing that child or family member can specifically do to deal with that issue.
No.
They need some kind of special care.
And the last piece that we probably haven't touched on is the actual community aspect. So loneliness is a large contributor to declining health in older ages. And so although you might have a guest wing of the house or a spare room, but if the kids are busy and the adult children are busy with their careers, loneliness is a big factor. And that's another reason why people want to be in these communities, because they're around others. There's socialization, there's activities, there's all these kind of things that not just from a safety standpoint, but from a mental health standpoint and a loneliness factor is another reason why we're going to see, people continue to move into these facilities.
Yeah, I think that makes a lot of sense. I mean, there's so many things to consider. So, in terms of cap rates in these facilities and debt, what are we expecting if we were to move along? And I realize, obviously, we're talking property over here, so each and every one is unique. But as an investor, typically speaking, what are you seeing deals trading at the moment for active living, independent, assisted, and skilled nursing?
So again, it's kind of gonna be a floating metric depending on property and location specific, but some recent deals, there's active adults trading a little lower because it's more like multifamily.
Yes.
So 5.8, 5.9. And then as you move along the curves for stabilized, 6 to 6.5. We've seen some assisted living's been trading at. Skilled nursing going to be a little higher than that.
Okay.
It's a little more difficult to operate. On the debt stack, there are mostly a lot of specialty lenders that service this space. Experience and track record, just like most of the classes, is going to be pretty important.
Yes.
Who's buying it? Do they know how to operate it? Are they in state? Are they out of state? But the capital stack's not going to look too different than maybe what you're used to seeing on a multifamily. Typical LTVs, 65, 70% LTV. You do have some all cash buyers in this space. As we've talked about, a lot of capital has been raised and is really interested in this marketplace. So I do talk to some buyers that, they have the ability to move very quickly. They're backed by very large capital in some of the finance centers like Boston and New York and Chicago. And so that's why on the larger product, you're typically going to have a more select group of buyers than you might have at this, what I might call the fragmented space, the mom and pop space.
Yes.
The $4 to $5, $6, $7 million buildings that are typically owned and operated by the same person or the same group. This might have been their career for the last 15 or 20 years. We're starting to see a lot of those opportunities on the lower end of the scale that are starting to emerge as people want to retire. And obviously 2020 has thrown a wrinkle in making it a little more difficult environment to operate in. And some of these people are kind of ready to cash out, if you will.
Yeah.
And so there's a lot more seller financing that will probably happen at the lower end of the scale. Not seeing a lot of carryback in institutional product, which is where I focus a lot. But on the fragmented scale, I think you've asked me, if I had money today, where would I buy? If I was just talking about my own personal pocket, I'm not quite at the point to buy a 5-building portfolio, but I'd say for individual investors or people that are syndicators that we see a lot in other asset classes, I see them calling me, asking me about product and trying to get into the space. Probably that 30, 40 units, we're seeing people buy it. Typically after 40 to 45 units, you can justify third-party management.
Okay.
There's kind of enough meat on the bone. But if you're going to buy a building and there's a good administrator in there and there's a good staff, they've got a good reputation and they want to stay on, it's typically just a matter of kind of changing the paperwork in the back. You don't touch anything. The residents might not even know that there's a new owner in there. And so that's where I see a lot of the smaller investors looking to play in the fragmented space.
And tell me, when you're playing in this smaller space, I would assume you're not just buying the building. I mean, you're essentially buying the operation too.
Correct.
Is that fair to say? Yeah. So
the bricks and the sticks and the operation are kind of one and the same.
Okay.
In that space.
And on the institutional space, a lot of the time you're possibly buying a building that's already being leased to a private operator.
You have, the typical kind of PropCo, OpCo models there are utilized most. Triple net lease is another kind of structure that you see a lot of groups, a lot of the REITs will have a diversification, but a lot of their structures are going to be triple net leased out to operators with some escalations in place. So not as many times as the actual operations trading, as it's more just the investment side of the equation is trading.
Okay, so if I'm a smallish investor looking for an opportunity today, I would essentially be looking at some of these mom and pop run institutions where I'm able to sort of get in and buy at a reasonable price, at least get some new fresh blood and professional management in, assuming the current guys aren't doing a great job. If they are, then obviously, as you mentioned, keep them in there and look to just increase the performance of the operation and the experience for the tenants. And I assume everything else would be similar to multifamily in the sense that you want to try cut expenses and increase the revenue.
Yeah. There's a lot of opportunity, I think, again, on that smaller side. If you've got a long-time owner-operator who's done a fantastic job with reputation management, they've got good occupancy levels, they've got good, reviews from residents and residents' families, but maybe they haven't really kept up with market trends and they haven't really kept up with what are the other, facilities in a 3-5 mile radius. What are they charging on private pay? So there's a lot of that opportunity for somebody to come in with just a little more of an investor hat to a building that's been well maintained and well run, but there's meat on the bone in terms of, just the investment economics of the deal, but maybe the operations have been just fine. So
Yes.
that's probably where I would be looking if I was a smaller investor, and I would be staying at that independent living, maybe into the assisted living space. I would not advise anybody just to jump right into skilled. It's a completely different animal.
Agreed. Okay, cool. Well, thank you so much for that. Where can people get hold of you and get in touch if they want to reach out?
Yeah, so a few different ways. Pretty active on LinkedIn. Anybody can connect with me there. My email is just Shane, SHANE, at Bull Realty, BULL realty.com. Feel free to shoot me an email. Happy to jump on the phone with anybody. If there's anybody out there that owns property in this sector, I'm happy to do a kind of a free analysis on what the property might bring in the market.
Great. And which markets are you focusing on?
So largely going to be focused in the Southeast United States, kind of from Virginia, Tennessee, to Georgia, the Carolinas, out to Alabama, Mississippi, Arkansas. But we do nationwide business. Anybody out there, and I'm kind of focused more on the institutional size product, 10, 15, 20 to 100 million, but I'm happy to talk to anybody.
Okay.
And if there's any education that I can give to your audience, it'd be my pleasure. I just love talking about this stuff.
Great. Well, thank you so much. We really appreciate your time and for being on the call. And look forward to diving into each of the senior housing levels in the curve at some point. I'm sure there's lots of detail on each of them.
You could do separate show on each of them for sure.
Well, that's the plan. So we'll have you back at some point in time.
All right.
We'll air this one first. And I'm extremely grateful for you giving up your time. Thanks.
Thanks for having me, Rikki.
Thanks, Shane. Bye.